Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about a stock that was suggested by a subscriber. That stock is Microsoft. Microsoft is one of the world's largest independent software makers, and today we will be reviewing the company's 10K to get a better idea of its business segments. We will be reviewing the company's key ratios, performing a discounted free cash flow DCF analysis to find the intrinsic value of the company, and finally do an expected rate of return calculation to see if you were to invest in Microsoft at the current stock price, what kind of return can we expect on this investment? So let's dive in and review Microsoft. Hey guys, let's start off by looking at the Form 10K, which is the annual report that Microsoft filed with the SEC. This is for the fiscal year that ended June 30th, 2020. And on page 90 of the report, the company provides an overview of its business segments. It states that it has three operating segments: its productivity and business processes, intelligent cloud, and more personal computing. The first operating segment is the productivity and business processes, which consist of products and services in its portfolio of productivity, communication, and information services, spanning a variety of devices and platforms. Some of the offerings in this segment includes Office and Microsoft 365, Skype, LinkedIn, and so forth. The second operating segment is its intelligent cloud segment, which consists of its public, private, and hybrid server products and cloud services that can power modern business and developers. Some of the offerings in this segment includes Microsoft Azure, SQL Server, Windows Server, Visual Studio, GitHub, and so forth. The third and last operating segment is its more personal computing segment, which consists of products and services that put customers at the center of the experience with its technology. Some of the offerings within this segment includes Windows operating system, devices including Surface and PC accessories, gaming including Xbox hardware, and search. Next, Microsoft gives us an idea of the revenue breakdown of each operating segment. For the year 2020, 32% of the company's total revenue came in from its productivity and business processes, 34% of its revenue came from its intelligent cloud segment, and 34% of its revenue came in from its more personal computing segment. When we look at the operating income, and operating income is what we get when we subtract cost of goods and operating expenses from the company's revenue, we can see that for the year 2020, 35% of the company's total operating income was from its productivity and business processes, 35% of its operating income was from its intelligent cloud segment, and 30% of its operating income for 2020 was from its more personal computing segment. We can see that Microsoft's operating income and revenue is well diversified amongst its three operating segments. In other words, Microsoft is not overly dependent on one operating segment in order to make money. After that, Microsoft points out that no sales to an individual customer or country other than the United States accounted for more than 10% of revenue for fiscal year 2020, 2019, or 2018. Microsoft then provides this table which shows the revenue brought in from the geographic areas. We can see that for the year 2020, United States accounted for about 51% of the company's total revenue, and other countries accounted for 49% of its total revenue. On the next page, Microsoft gives us an idea of the revenue brought in from its significant product and service offerings. We can see that its server products, office products, and cloud services account for majority of its total revenue. And finally, as far as its commercial cloud revenue goes, which includes Office 365 commercial, Azure, the commercial portion of LinkedIn, Dynamics 365, and other commercial cloud properties, was $51.7 billion for the fiscal year 2020. Now that we have a good understanding of Microsoft's operating segments and its revenue breakdown, let's review the company's fundamentals by focusing on its key ratios. Hey guys, now let's review Microsoft's key ratios. I'm on Morningstar looking at Microsoft Corp. Under key ratios, we have the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in from its sales. Back in 2011, Microsoft's revenue was about $70 billion. For the year 2020, it was about $143 billion. And for the trailing 12 months, it's about $153 billion. Over the past 10 years, Microsoft's revenue has been trending upwards. Next is the operating income. The operating income is what we get when we subtract the cost of goods and operating expenses from the company's revenue. Back in 2011, the company's operating income was about $27 billion. For the year 2020, it was about $52 billion, and for the trailing 12 months, it's about $60 billion. Over the past 10 years, Microsoft's operating income stayed fairly consistent from 2011 through 2015. Then it dipped down to about $21 billion in 2016. In 2017, it was about $23 billion, and ever since then, we see that Microsoft's operating income has been increasing every year. Next is the operating margin. The operating margin is the ratio of the company's operating income to its revenue. Ideally, we want to see the company's operating margin to be staying steady or increasing. Back in 2011, Microsoft's operating margin was about 38.8%. Over the next few years, the company's operating margin declined every year. It got all the way down to about 25% in 2016. After that, we can see that Microsoft's operating margin has been increasing every year, and for the trailing 12 months, it's sitting at about 39.2%. After that, looking at the net income is the bottom line of the income statement. This is the amount of money that's left with the company once it has paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2011, Microsoft's net income was about $23 billion. For the year 2020, it was about $44 billion, and for the trailing 12 months, it's at $51 billion. Microsoft's net income has been increasing every year since 2018. Next, looking at dividends per share. Back in 2011, Microsoft paid out about 61 cents per share as dividend. For the year 2020, it paid out about $1.99 as dividend, and for the trailing 12 months, it paid out about $2.09 per share as dividend. Microsoft has been hiking its dividend every year for the past 10 years. Next, looking at the shares outstanding. Back in 2011, Microsoft had 8,593 million shares outstanding. For the year 2020, it had 7,683 million shares outstanding, and for the trailing 12 months, it has 7,646 million shares outstanding. Over the past 10 years, Microsoft's shares outstanding number have been decreasing every year. That is a good sign, as the process of buybacks actually helps increase the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. Back in 2011, Microsoft's book value was at $6.82 per share, and for the trailing 12 months, it's at $17.27 per share. Over the past 10 years, Microsoft's book value was always positive, which tells us that the company always had more assets than its liabilities on its balance sheet. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Back in 2011, Microsoft's free cash flow was about $24 billion. For the year 2020, it was about $45 billion, and for the trailing 12 months, it's at $50 billion. Ideally, we want to see the company's free cash flow to be staying steady or increasing. Microsoft's free cash flow has been increasing since 2015. I will be using the past 10 years of free cash flow for my expected rate of return calculation, and I will be using the 2020 figure of $45.234 billion for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line, so it compares the company's net income to its revenue. Ideally, we want to see the company's net margin to be high, and a high net margin indicates that the company has more money left over after it has paid for its expenses. Back in 2011, Microsoft's net margin was about 33.1%. For the year 2020, it was about 31%, and for the trailing 12 months, it's about 33.5%. What this means is every $100 that the company made over the past 12 months, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had $33.5 left as pure profit. Next, looking at the return on equity. The return on equity compares the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities who had a return on equity of 8% or greater every year for the past 10 years. Back in 2011, Microsoft's return on equity was about 45%. For the year 2020, it was about 40%, and for the trailing 12 months, it's about 43%. Microsoft's return on equity over the past 10 years has always been greater than 8%. Additionally, whenever a company's return on equity is greater than 15% for a long period of time, it indicates that the company has a moat. In other words, the company has a competitive advantage, and that appears to be the case with Microsoft. Next, looking at the return on invested capital. The return on invested capital gives us an idea of how efficient the management is at allocating the company's capital and getting a return on that investment. Back in 2011, Microsoft's return on invested capital was about 38%, and for the trailing 12 months, it was about 28%. We compare this return on invested capital to Microsoft's current weighted average cost of capital, which is about 6.2%. We can see that the return on invested capital is much greater than the company's weighted average cost of capital. The weighted average cost of capital is also known as the hurdle rate that the management has to beat in order to create shareholder value. So we can clearly see that Microsoft's management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Back in 2011, Microsoft's interest coverage was about 96 times. For the year 2020, it was about 21 times, and for the trailing 12 months, it's about 26 times. Benjamin Graham, the father of value investing, preferred to only invest in securities who had interest coverage of at least 5 times or greater. Now let's look at the financial health of the company, focusing on its liquidity ratios. The first one on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. Ideally, we want to see the company's current ratio to be greater than 1.5. Back in 2011, Microsoft's current ratio was at 2.6, and for the latest quarter, it's at 2.58. Over the past 10 years, the company's current ratio has always been greater than 2.0. Next, looking at the quick ratio. The quick ratio is similar to the current ratio except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want to see the company's quick ratio to be greater than 1.0. And a ratio greater than 1.0 indicates that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2011, Microsoft's quick ratio was at 2.35, and for the latest quarter, it's at 2.36. Over the past 10 years, the company's quick ratio, similar to its current ratio, has always been greater than 2.0. Next, looking at the financial leverage. The financial leverage compares the company's total assets to its shareholders' equity. A higher financial leverage number tells us that more of the company's assets are financed through liabilities. Back in 2011, Microsoft's financial leverage was at 1.9. It increased all the way to 3.33 back in 2017, and ever since then, the company's financial leverage has been decreasing, and for the latest quarter, it's at 2.34. Finally, looking at the debt-to-equity ratio. The debt-to-equity ratio compares the company's total debt to its shareholders' equity. Ideally, we want to see the company's debt-to-equity ratio to be less than 1.0. It's even better if it's less than 0.5. Back in 2011, Microsoft's debt-to-equity was at 0.21, and for the latest quarter, it's at 0.49. These four liquidity and financial health ratios that Microsoft has are actually better than those of its competitors such as Apple and Oracle. Now let's look at the efficiency ratios. Focusing on the days sales outstanding, this number gives us an idea of how many days go by from the day Microsoft recognizes its sales to the day it actually receives cash for that service rendered. Back in 2011, Microsoft's days sales outstanding was at 73 days, and for the year 2020, it was about 78 days. Over the past 10 years, the company's days sales outstanding number has stayed fairly consistent, and that is something we want to see. We do not want to see a company's days sales outstanding number to be increasing, as that means that the company is being aggressive with its accounting, as it is recognizing its revenue sooner so that it can inflate its income numbers on its income statement. Next, looking at the days inventory. This number gives us an idea of how many days does Microsoft's products sit in its inventory before they're sold. Ideally, we want to see the company's days inventory number to be staying steady or decreasing. Back in 2011, Microsoft's days inventory was about 25 days. It increased all the way to about 31 days back in 2014, and ever since then, the company's days inventory number has been decreasing. For the year 2020, it's about 16 days. Next, looking at the payables period. This number gives us an idea of how many days does Microsoft take to pay its suppliers. Back in 2011, the company's payables period was about 96 days, and for the year 2020, it's about 86 days. Finally, looking at the inventory turnover number. The inventory turnover gives us an idea of how many times does Microsoft's inventory go through its system in a calendar year. Back in 2011, Microsoft's inventory went through its system about 14.75 times, and for the year 2020, it went through its system about 23.28 times. Ideally, we want to see the company's inventory turnover number to be staying steady or increasing. So this is definitely a good sign that the company's inventory turnover number has been increasing. Now let's compare the company's current valuation to that of the S&P 500. The S&P 500 is the aggregate of the top 500 companies in the United States. The first item on the list is the price to earnings ratio. Microsoft's PE is at 38.1, whereas S&P 500 is at 28.9. Next is price to book. Microsoft has a price to book of 14.8, whereas S&P 500 has a price to book of 4.1. After that, price to sales. Microsoft's price to sales is at 12.8, whereas S&P 500 is at 3.0. Next is price to cash flow. Microsoft has a price to cash flow of 28.8, whereas S&P 500 has a price to cash flow of 17.1. And finally, the dividend yield. Microsoft has a dividend yield of 0.8%, whereas S&P 500 has a dividend yield of 1.6%. We can see that on all these valuation metrics, Microsoft is overvalued when compared to the S&P 500. Hey guys, now let's review Microsoft's discounted free cash flow DCF analysis. Over here, I pasted Microsoft 2020 free cash flow number that I got from Morningstar, which is $45,234,000,000. I'm assuming the annual growth rate of free cash flow to be 12%. What this means is I expect Microsoft's free cash flow to grow at 12% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate of 5%. What this means is after the 10-year mark into perpetuity, I expect Microsoft's free cash flow to grow at 5%. The company has 7,646 million shares outstanding and has a long-term debt of $59,578 million. I got this number from Microsoft's balance sheet. After taking into account all these inputs, we get the intrinsic value per share to be about $209 per share. When we compare this intrinsic value to the current stock price of about $258.5 per share, we can see that the current stock is trading about 24% above the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $500 billion. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up, which come out to about $1.7 billion. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $209 per share. Now, if we disregard the perpetuity component, in other words, if we think that Microsoft is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without the perpetuity to be about $58 per share. And if we disregard both the debt and the perpetuity, then we get the intrinsic value without the debt and perpetuity to be about $65 per share. Finally, let's edit the discount rate a little bit. We know that the company's weighted average cost of capital, also known as its hurdle rate, is about 6%. If we add a 3% margin of safety on top of that, we get 9%. And if we make our discount rate 9%, then we get the intrinsic value to be about $270 per share. And in that case, we can see that the current stock is trading about 5% below the company's intrinsic value. Hey guys, now let's review the expected rate of return calculation for Microsoft. Over here, I pasted the past 10 years of free cash flows that I got from Morningstar. All the numbers here are in millions of US dollars. This is the yearly free cash flow trend that we get over the years. We can see that the free cash flows have mostly been steady and have been increasing since 2016. Next, looking at the future data and predictions, I'm assuming that there's a 40% likelihood that Microsoft's free cash flow will grow at 12%. There's a 45% likelihood that its free cash flow will grow at 8%, and a 15% likelihood that its free cash flow will grow at 4%. These are the potential free cash flow rates that we get into the future. After taking into account the numbers of shares outstanding, which is at 7,646 million shares, at the current stock price of about $258.5 per share, we can expect to get a return of about 2.5% on this investment. What this means is if you were to purchase a share of Microsoft at the current stock price of about $258.5 per share and hold this security through 2075, then we can expect to get an annual return of about 2.5% on this investment. Hey guys, now let's wrap it all up. We reviewed Microsoft's 3 business segments and the revenue brought in from each business segment. We saw that the company's revenue, operating income, as well as net income for the past 10 years has stayed fairly consistent and has been increasing over the past few years. We saw that Microsoft's operating margin over the past 10 years has stayed fairly steady, which tells us that the company is consistent at managing its costs and getting a steady profit out of its core business. Microsoft has been hiking its dividend every year for the past 10 years, and the company has been buying back its shares as its share count has been decreasing every year for the past 10 years. Both the dividend hikes as well as the share buybacks indicate that the company is shareholder friendly. Microsoft's return on equity has always been greater than 8%. In fact, for most of the years, it has been greater than 15%, which indicates that the company has a moat. In other words, Microsoft has a competitive advantage. Microsoft's return on invested capital has been greater than its weighted average cost of capital, which tells us that the management is creating value for its shareholders. Next, we saw that Microsoft's interest coverage has always been greater than 5 times, and its financial health, which includes its current ratio, quick ratio, financial leverage, as well as debt to equity ratio, is better than its competitors such as Apple and Oracle. After that, we looked at Microsoft's efficiency and saw that Microsoft is more efficient now at going through its inventory than it was 10 years ago. When we compared Microsoft's current valuation to that of the S&P 500, we saw that on all the valuation metrics, Microsoft is overvalued to the S&P 500. Next, we looked at the company's discounted free cash flow DCF analysis and found that when we use a 10% discount rate, Microsoft's intrinsic value comes out to about $209 per share. And when we use a 9% discount rate, the intrinsic value comes out to about $270 per share. We compare the intrinsic value of $270 per share to the current stock price of about $258.5 per share. We can see that the current stock is trading about 5% below the company's intrinsic value. Next, we looked at the company's expected rate of return calculation and saw that if we were to invest in Microsoft at the current stock price, we can expect to get an annual return of about 2.5% on this investment. Overall, we saw that Microsoft has strong fundamentals, it has stable dividend and share buyback programs. Microsoft's revenue from its cloud services is expected to remain strong and grow in the future. However, at the current stock price, the company is overvalued and it does not provide the margin of safety needed for a true value investment. Hey guys, that is all I had for you this week. Hopefully you found this video on Microsoft interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions as to which stock I should review next, please leave it in the comment section below. I will greatly appreciate it. Thank you.